And I'll give you one example just to show you one of our models. I'm not going to talk about the model, but here's a shock where suppose all of a sudden we take the scale of the shock we observed in the US, which was 8%, 800 basis point risk premium, versus one that we think will not go away, versus one that we think will go away gradually. So it goes 8% in the first year, 6, 4, 2, and then it's back to where it was. And you can see that this is a change in real US GDP, and this is all expressed as difference to what would have been the case. So here's an economy that's growing. This is the difference between what happened when the shock comes versus growth. If you think it's permanent, in the first year your economy is in recession. You lose 3.5% of GDP, and because this is a long, drawn-out reduction in capital, your economy stays in recession for a couple of years, and then you end up with a permanently lower level of output. Now that's not the growth rate, that's the level. So you do eventually get back to a growth path, but it's at a much lower level. If you think it's temporary, this shock is pretty bad, but it goes away eventually. Now the implications on the capital stock are really quite dramatic. So here's the US capital stock if you think it's permanent, that in a decade the capital stock is basically 16% lower than it otherwise would have been. And this process of deleveraging, decapitalisation of the economy is a long, painful process. And so one hopes that you're not in that equilibrium, one hopes that you're in this equilibrium. The second shock, which is worth mentioning about, because the destruction of value that we saw in that first one is a destruction of value, and really a government can't put it back. All right? There's no government policy that will create the wealth that's been destroyed by this policy. The second shock, which I think is going on, is that households all of a sudden became very risk averse. They were worried about the future, they were worried about their jobs, they were worried about their houses, and they stopped spending. And the one way of modelling that is to say, suppose as well as firms having these risk premia, suppose the household has a risk premia, and suppose it goes up by 4% a year, how do people change their behaviour if they become very risk averse? Versus one where it's a shock that hits us but it goes away. And this is really quite interesting because in the permanent case, don't forget, only a 4% change in the household discount rate wipes out 11% of US consumption. So this is a very big shock that comes along. And the interesting thing with that is that that shock actually doesn't destroy a great deal, it just moves consumption from the present to the future. Because you're saving the consumption you would have undertaken, you can actually consume that in future years. And so you end up shifting the economy from present consumption to future consumption. That is actually a good thing to know, because what that means is that policy, whose only role is to shift spending from one period to another, because again, I don't think government policy creates a great deal, it just shifts the timing of spending. This gives you the capacity to shift that future consumption that would have been there into the present to help dampen the shock. And so there is some optimism if it's really a household response. You can see that if the households think this thing is temporary, even though in the first year you've got major panic, it's major panic that you know is going to go away, and so you get a very different outcome. And you can see the GDP impacts of this are very, very different. You get a massive wiping out of your economy if in fact your consumers stop spending. And that's not surprising if you think about it. Think of a typical economy. Let's take Australia. Consumption's 55 to 60% of GDP. Investment is 20% of GDP. Exports are 20% of GDP. The difference is government spending. Most of the economy is what's going on here, not what's going on overseas. So even if you took out 5% of export growth, suppose our exports contracted by 5%, that's what we're seeing right now. It's only 5% of 20% of your economy, so it's a contraction in GDP of about 1.5%, not counting multipliers. So a contraction of exports that we're seeing cannot cause a recession in Australia unless Australians lose confidence, or unless Australians do this. And that is a key insight for most economies. So what are the core shocks? Okay, and this is very different across countries, and you cannot use the same policy prescription in every country because each country is experiencing different things. In the US and UK, we have a financial crisis. In other countries, we are faced with a fall in exports, a collapsing of international trade, but really what's hurting countries is a loss of domestic confidence. And so it's the contraction in consumption and investment. Now, again, as I pointed out, a lot of people think of this being just a demand shock. Just that there's not enough demand out there, let's put demand back in the economy and everything will be fixed. As I showed you with the capital stock graph, this is a supply shock as well. If businesses close down, the capacity to produce is reduced, and therefore our capacity to go back to where we were is greatly diminished. And so what we have to do is prevent the supply side from contracting as much as it potentially is. Let me briefly touch the global policy responses, because I want to make a few points that first-year economics actually teaches us, and a lot of people may not actually be aware of this, mostly because a lot of people think about economics in terms of a single economy. And what we know is in a single economy, if you have open capital markets, so capital can flow across economies, monetary policy is very effective. If you cut interest rates, you tend to depreciate the exchange rate because capital flows out. That depreciation of the exchange rate improves your exports, and that's what stimulates your economy. Now, in addition, of course, it stimulates investment and consumption, but the trade effect is pretty important. Now, fiscal policy, on the other hand, is much less effective in a single country, because in fiscal policy, if you increase the budget deficit and you put up interest rates, or you have to borrow, and that drives up interest rates, that drags capital in from overseas, it appreciates the exchange rate, and it dampens your exports. So if you're doing it in an individual country, you're much more effective using monetary policy for your own domestic stabilisation than fiscal policy. That's a standard result from what's called the Mundell-Fleming model. The interesting point is if it's a global shock, the exchange rate effects all cancel out. And if it's a global shock, then coordinated monetary policy is a lot less effective because the exchange rate effects are gone. Although some countries in the current environment are trying to depreciate their exchange rates, and so if everyone tries to depreciate the exchange rates, obviously you get no policy stimulus because everything nets out. But interestingly, coordinated fiscal policy is more effective because you're not crowding out your exports because everyone's increasing demand together. And I think it's important to keep that in the back of your mind. The final result that comes out of all these models that we do is that temporary fiscal policy is far more effective than permanent fiscal policy. And that's because with temporary fiscal policy, you get the demand stimulus, but you don't have to worry about the fact that you've created this large amount of debt that has to be financed over future years, which crowds out spending in the financial markets. Finally, the composition does matter. And it does matter because there are certain types of fiscal policy that stimulate the supply side, like infrastructure spending, like tax changes, and there are others which just stimulate the demand side but do nothing for productive capacity, like pink bats and things. So what's the role of policy? Again, I think we have to be realistic about what role policy can play. We think we know in economics that monetary policy is a very powerful instrument, but what it does practically is it moves spending from one period to another. It brings it from the future to the present, or it takes it from the present and pushes it in the future. The economy's overheating, you raise interest rates, you push the spending from today, it'll turn up in the future. And so monetary policy, under my view of the world, is a very powerful tool, but it just changes things through time. Fiscal policy is very similar, in fact. It just shifts demand from one period to another. If you borrow to spend today, you have to pay it back in the future, which is less spending in the future. Now, there is a difference, and that is with fiscal policy, you can change people's incentives. You can change investment. You can do infrastructure investment, which gives you returns to your private economy. So there is the secondary role for fiscal policy that's very important. Suppose this is the new world. 8% risk premium, no one wants to invest, everybody's scared, and that's the new world. Then we're in for a long process of capital destruction. The global economy is going to shrink and we've got a serious problem. And no matter what you do on the demand side, you can't actually get away from that process of deleveraging. All you can do is smooth out the bumps, because policy can smooth out the bumps. So the second scenario is that risk returns to pre-2007 levels so that we actually go back to where we were 2 years ago. Now, I just find that almost impossible to be the case, but suppose it does. Then we're going for a very strong demand, a very strong recovery. And during the recovery, which would be coming now, we would have this demand stimulus overlaying that. And we're creating ourselves a fairly significant problem because we've got a lot of fiscal stimulus, a lot of monetary stimulus in the global economy, and we've got a lot of government borrowing to finance the deficit. So we're going to run up against this lack of capital, in fact, as we come out of this world. I think this world is very unlikely. The other scenario is that we go back to where we were during the 90s, which I think was a much more plausible scenario. Risk premia were moderate but not excessive. Even in that world, we have a long period of slow growth in the US and the UK because they've got this financial crisis asset overhang problem that needs to be unwound. But you can be very optimistic about developing countries because they haven't got this problem and they've got great growth potential coming over the future decades. Are we seeing early signs of a recovery? Well, actually, we don't know. You can be optimistic, and if you're optimistic, you see a lot of pictures now which fish hooks at the end. These massive collapses, and then you get a kick at the end. We've got commodity prices rising. We've got the Chinese economy is showing a lot of strength, a lot of potential strength. The Chinese themselves appear to be confident because they're out buying all of these resource assets all over the world in anticipation for the next big cycle. So you can be optimistic. You can be pessimistic as well, and there are a number of key risks. One is that the European system is putting a lot of strain on the euro. If you look at the yield spreads on different countries in Europe, we've got Greece and Ireland with yield spreads relative to the German Bund of over 200 basis points and Ireland of about 150. That doesn't look like a common currency area. Although having said that, and I made this comment in the US recently, and someone pointed out that the state government bonds in the US economy have similar spreads, and they have a common currency, so maybe you shouldn't be too worried about this. And finally, you have to be a little bit worried about Eastern Europe because Eastern Europe today looks just like East Asia did in 1997, and I think there is some risk there. So my view of what's going on is we've had a series of shocks over the last decade, and each of these shocks has kind of fed into either a policy response or a market response, which then was unhelpful for the next set of shocks. But the big shock we face right now is a complete loss of confidence. That's the one that's really hurting us. And a loss of confidence isn't just, these risk premia that we see priced in financial markets are really real shocks to the economy. A third point which is really important is trade is not the transmission mechanism per se. If you look at the sort of linkages in my model, and my model has all global trade, the shock in the US, the spillover to the rest of the world wasn't just the trade channel. It's relatively small, but still there. But the big shock was the synchronisation of the loss of confidence. It was the fact that everybody lost confidence at the same time, roughly. And so it wasn't so much that trade caused this or linkages in the global economy through trade and through markets caused it. It was basically a loss of confidence. Monetary and fiscal policies, and again, I'm not talking necessarily about Australia here, but monetary and fiscal policies really can't do much to help you on the supply side. They can help you smooth demand. The big role is to raise confidence. So when you're putting together a package, whether it's at the whether it's at the G20 or whether it's at the nation level, it's not so much the package per se that's going to get you out of this hole, it's what that package does to people's confidence. So when policies are being designed, it's the confidence angle. It's to get those risk premia down that's going to give you the biggest bang for the buck, not the fact that you're spending 10 billion or 50 billion or $1 trillion, because that's actually not going to get you out of this hole. And again, we have to be wary that this cycle will come to an end in some form, and we have to be very careful that the problems we're seeing, which are regulatory problems, institutional problems at the nation level and at the global international institution level, they have to be reformed because there will be more shocks. And these shocks won't necessarily be the same as the one we're experiencing now. And we need to have the sort of flexibility that we've actually demonstrated in Australia is very, very powerful to withstand these shocks. And I think Australia is a very, very good case study of how you set up financial regulation, how you set up regulatory environments, how you set up policy frameworks, and how you run fiscal surpluses so that you have got enough resources to actually undertake the sort of investments for long-run growth that are required. So I think it's very important to do the reforms, but the number one thing now is not to play politics with this crisis, but to actually instill confidence that we actually know what we're doing in the global economy. And there are lots of papers at sensiblepolicy.com. I must mention, there's even one in 2004 with David Vines, and it's also at the Lowy Institute website, which looks at what happens if there's a global loss of confidence and we end up with this massive shock to risk premia. So that's 2004. So I'm not saying we predicted what would happen, but a lot of people were worried about these building pressures, and I'm happy to stop there.
Thanks very much, Warwick. We've got about time, 20 minutes for questions. Could I ask you to wait until the microphone comes and to tell us who you are when the microphone arrives? It will be switched on.
Richard Heald. How do you rate the magnitude of the Eastern European risk with what's happened with the collapse in the US housing market? So is that are we going to see that as an equally large risk to what has happened, or something much lower?
Well, the US housing market shock is a very different shock to the loss of confidence that's going on in Eastern Europe. And the US economy is a much bigger share of the world than the Eastern European economies. The good news for Eastern Europe actually is that the G20 did put a lot of financing into the IMF, and that can be used to help these economies stabilise. There is a popular view that the Western European banks are highly exposed to Eastern Europe. They are exposed, but I wouldn't regard it as highly. My understanding is the worst exposure is about 14% of an Austrian bank. So even if the Eastern European economies run into serious problems, it'll shake confidence, but it won't be a major negative shock to the world economy, in my view.
Ruth Sussler with the Canadian Consulate. The Conference Board of Canada wrote a paper back in February of 2009. It was entitled International Financial Policy Reforms and Options for Canada, Think Globally, Act Locally. One of the suggestions was that there would be a potential new role for the IMF that might involve it intermediating the vast wealth held in sovereign wealth funds. Could you comment?
Yeah, I mean, I think I can comment directly and indirectly. One of the issues of the IMF that has to be sorted out sooner rather than later is the composition of the key countries. The developing countries, particularly China and India, don't have a big enough share in the IMF structure. So we need to get the composition right. The IMF has a critical role to play, and I think it's probably the institution with reform that we would rely on to play that role. On the issue of sovereign wealth funds, I think we have to be very careful about directing sovereign wealth funds to do very much at all. I mean, this is an important source of global savings, but I think what we need to do is have framework structures, regulations which are transparent and clear so that the sovereign wealth funds will actually feel willing to go to economies that need financing to get a rate of return. I think the role of government generally is to get in there and create the incentives, the compliance, the monitoring, the regulatory framework so that working in conjunction with markets, you end up with a good outcome from the global point of view. So I think the sovereign wealth funds are a critical part of financing going forward, and they are playing an important role even now. Early on in the crisis, there were sovereign wealth funds that went in to try and fix the US financial system by buying up banks. It turned out that subsequent events didn't favour those decisions, but I think sovereign wealth funds will be a key part of the recovery process.
Forrest and BT. The IMF published a report in early March looking at the cost of the global financial crisis and also put it into perspective relative to the cost of the ageing population. And I'm just wondering whether that has any bearing on requirements for capital, demands for capital and risk premia for your thesis going forward?
I've actually done a fair bit of work on demographic change, and again, I think the goal here is if we can get the markets together with appropriate regulation to give the right signals, that we can channel private capital into the appropriate capital development over time. For example, in Japan, you need to be investing heavily in the healthcare system because Japan is the most dramatic case of population ageing, perhaps outside of Italy, or even Russia is a problem, but take Japan. Now, the problem with Japan is that because of the distortions and protection of agriculture and protection in the service industries, any capital that's invested is being channeled into those industries because there's no incentives to channel it into the healthcare sector. So my view would be that you've got to get the incentives right, the structures right, the distortions out of the system where they're creating bad investment decisions, and with a combination of government and private capital, deal with these longer-term issues of ageing, and climate change is a bigger issue than ageing, actually, depending on your view of the world. I think it's a big mistake to think that a government will take over everything and all the planning, and I equally think it's a big mistake to say that the private market can do everything without regulation. You need a combination of the two, and I've always pushed that in my climate change policy, but that's a different seminar.
David Lizio from Marsh. Your response just then touched on perhaps your answer to my question, but I was wondering if you could comment further on the type of regulatory shift on a global level that would be required to inject more confidence into the system.
Well, I think that, firstly, I'm a big fan of coordination of national actions. because different countries have different characteristics, and I think it's a mistake generally to try and create a policy that everybody can follow exactly. But I think you need a framework for coordinating. And the BIS is a good example where national central banks implement their policies, but they're actually coordinated through a global framework. I also think it's a big mistake, and I see this in the US occasionally with my colleagues there, is to say, well, this particular part of the US system doesn't work, let's invent something. Instead, what you should say is, let's look around the world. We've got 180 examples around the world. Some of them blew up fantastically well, others survived. Which ones worked and why? And can we take those lessons from even small countries, medium-sized countries, large countries, can we take those examples and use them to inform us? In other words, evidence-based policy development, rather than either starting from scratch and rewriting a new textbook, or going to the textbooks we already have and saying, well, this is theory 3. We've tried 1 and 2, now let's try 3. Let's look at what has worked. And Australia, again, in many examples, is a pretty good example. Canada's doing well as well. There are parts of Latin America, Brazil, for example, is coming through this crisis remarkably well due to reforms from the previous crisis. So I think, evidence-based policy where it's evidence from other countries, and sometimes that's hard for big countries to think about, but I think that's a very important way of moving forward.
Thanks, just behind there.
Oh, let me just add to that. It's also got to be learning by doing. So you don't just lock yourself into a 100-year policy that's inflexible. You have to be able to adjust it as new information, as new shocks, as new evidence emerges.
Chris Sweeney, I'm from Macquarie. I wonder, just a very short question, the recent G20 meeting in London, I wonder whether you can give us your thoughts on that and the outcome of that meeting.
Well, I think the best part of and I think that is a very useful meeting, because what it came out with was a confidence-building announcement, which actually, if implemented, actually does have meat to put on the bones. The problem now is whether or not the sort of policy funding of the IMF will actually occur. If we go back, there was a classic summit in 1978 in Bonn, at a time when the world was facing a problem of no locomotives for growth. And countries got together and came up with a policy announcement which actually had a positive impact when announced, but then disappeared and actually caused a subsequent economic slowdown. So the countries that have promised have to deliver now. And we have to see the IMF reformed. We have to see the IMF given all these resources. And we have to see countries really getting in there and showing that they're cooperating. As soon as the world thinks countries are beggar thy neighbour, then we're in big trouble. And the biggest indicator of that will be if we start seeing trade protection entering into the global economy. After the G20 meeting last year, several countries who promised not to do it went back and implemented agriculture subsidies, production subsidies, all sorts of interventions. And that's a danger. So again, I would actually hope that the Doha round now actually gets a big push from this. We do have the danger of protection in the financial sectors coming out of some of the regulatory interventions that are going on. But I think as long as this is coordinated and seen to be coordinated, and as long as there's a good translation to the general population that we're actually doing something, and that this is really something we can get through, we've got the answers. It's not that the world is blown up around us and, oh my God, this is terrible, because that'll just undermine confidence, and then we're going to be in a worse position than we currently are.
John Darwin, thank you very much for your talk. It's fascinating. I've got a personal problem. My brother's still living in the third world. I just wonder about the UK. How, when you have the chairman of the Bank of England arguing with the Prime Minister publicly about the capacity of the UK to borrow, how about a state is the UK in? And the second one is really the financial services industry has grown hugely in the last decade. And I just wonder, in reference to your regulation, what sort of regulation do you think needs to be applied to the financial services industry, which has clearly got a lot to answer for in terms of the generation of this issue?
The UK is quite unique in the sense that financial services is a very big part of the UK economy. And financial services is the sector that's been completely devastated by this shock. So the City of London is reeling. There's just no other word for it. Now that pessimism by the commentators is going to create pessimism across the population. It is very unhelpful for policymakers. It's also unhelpful for not just policymakers in institutions, but of leaders of political parties to have public debates which are undermining confidence in any country. So I think it's important that, and the Bank of England, I didn't talk about the Bank of England, but Northern Rock and some of the issues related to are UK-specific problems, and I was actually painting this as just a US problem. Actually, the US is not the only source of the shocks here. There was some shock coming from other countries. In terms of regulatory reform, again, I think the transparency and the global coordination is critical to coming up with the regulatory systems. Even though whatever comes out for the UK should be a UK-based system, it should be reasonably consistent with what the US does. It should be consistent with what other countries are doing, but it should be cooperatively put together. At the moment, again, the UK, I think, has a long period of asset restructuring ahead of it, unless there's a major, major boom in the world economy, which I think has very low probability. The UK is unfortunately going to cut quite a few years ahead of very slow growth.
And a final question down here.
Jay Horton. Warwick, thank you for your talk. It was very enlightening. I wanted to talk about the causes of the GFC and get your comments on whether the economics profession has been overzealous in its recommendation of deregulation or deregulatory policies, particularly in the finance sector. In the words of Simon Johnson, the former chief economist of the IMF, he said the river of deregulatory policies, and he was talking mainly about the US, is or has been in hindsight astonishing. And he goes on to talk about the various forms of deregulation that occurred in the last decade. I'll mention a couple just to sort of seed the discussion. The repeal of regulation separating commercial and investment banking, a congressional ban on the regulation of credit default swaps, a light touch at the SEC in terms of its regulation, and an international agreement to allow banks to measure their own riskiness. So, in hindsight, was a cause of the GFC the policies of deregulation, and what do we learn from that?
Yeah, again, it's not the deregulation per se, it's the way that regulation is formulated. We had regulation reform in Australia, which turned out under Hawke, Keating, Howard. We had regulatory reform, which was, you could argue, was a form of deregulation, but it was really a form of adjusting the regulations, and they turned out to be a good thing for the Australian economy. We also introduced a lot of flexibility. The US system, you can identify what you pointed out. You could also identify other things like the change in the law so that Fannie Mae and Freddie Mac would lend to low-income households. And these regulatory changes occurred under both Clinton, Bush, Clinton, Bush administrations. And so this is accumulation of bad regulation, in my view. So it's not the concept of deregulation, it's how you do the regulation that's a problem. And we know that markets need to be regulated. Now, the question is, how do you do it? And how do you create the incentives and the monitoring mechanisms and the enforcement mechanisms which enable you to have a transparent system so people can value assets? And again, this issue of executive pay, it shouldn't be that we just stop paying executives vast amounts of money. What we should do is we just build the payment to executives into the risk evaluation of the performance of the company as part of a regulatory environment, and then let the investors and shareholders look to see what the remuneration is doing to the performance in terms of risk-return ratios. So I think there are very good ways to bring in, to identify the problems. We can see the problems, but to bring them into a framework which is transparent and something that the market itself does a bit of self-regulation, but where there is a regulator with teeth. And the best regulators with teeth are the investors who pull their money out if they don't like what's going on. We need to do that. We have to follow that strategy. And it's not a deregulate, it's not a straw man, we shouldn't deregulate. And most economists who work in this regulatory area understand it's optimal regulation we're talking about, not or otherwise.
Could I ask you now to join me in thanking Warwick? One of the points Warwick made was the need for confidence to get through all this. Confidence comes very centrally from people having an understanding of what's going on and thinking they can see where the future lies. And so for all of us, Warwick, that wonderfully clear and informed account was very useful. Thank you very much.